For years, the real estate narrative in South Florida has revolved around mortgage rates. Rising interest rates were blamed for slowing sales, reduced affordability, and investment paralysis. But this explanation is not only incomplete, it's misleading. The true problem in Florida's property market goes far deeper than interest rates. Even if mortgages returned to the impossible lows of the pandemic era, the math still wouldn't work. Let's cut through the noise. Investors and home buyers aren't backing off because they can't get a 3% loan. They're backing off because the real estate model itself is broken, especially in the condo segment. In markets like Miami-Dade and Broward counties, the costs of holding a property have outpaced its revenue potential. Even buying in cash, many units produce returns lower than U.S. Treasury bonds and with exponentially higher risk. Take a typical two-bedroom condo priced around $320,000. AOA fees alone can hit $700 to $1,000 per month. Add in property taxes, $6,000 to $8,000, insurance, vacancy, repairs, special assessments, broker fees, and somehow inflated maintenance sums, and your holding costs can exceed $2,000 per month before you've even accounted for mortgage payments. The average rent? Around $2,400 to $2,600. That leaves razor-thin margins, if any. Now imagine financing that same property with a dream rate of 2.5%, a rate we will likely never see again. Even then, your monthly payment would be about $1,000. Add it to the fixed costs, and your total outlay approaches $3,000 per month. The result? Negative cash flow. So if you're losing money with ultra-low rates, what's left to blame? Now let's take a quick pause. If you're enjoying these insights, go ahead and hit the like button or subscribe to the channel. It really helps us keep digging into the trends no one else is talking about. Alright, back to the topic. It's just a failure timing. The condo investment model in South Florida is broken because the underlying cost structure has inflated beyond what rental income can support, a systemic imbalance. Insurance premiums have exploded, HOAs are covering massive, somehow inflated maintenance, and property taxes have surged to compensate for municipal overspending. None of that is solved by tweaking interest rates. And it's not just condos. Single-family homes are no longer the safe haven they once were. While they avoid HOA fees, they inherit the full weight of repair and upkeep costs, and those aren't cheap. Roofing, plumbing, electric upgrades, and code repairs are now subject to expensive permits and months of delays. Property taxes and insurance alone can eat up over 40% of rental income. Worse yet, many investors are facing aggressive city code enforcement. City inspectors aren't protecting quality of life, they're hunting for revenue. From minor paint issues to technical permit violations, fees and fines are becoming a silent tax on real estate owners, eating into ROI and pushing many out of the market. To make matters worse, Florida is no longer benefiting from the same inbound migration boom it enjoyed during the pandemic. In 2024 alone, the state experienced a net outflow of over 500,000 people. Miami was ranked number 3 in the U.S. for outbound migration, right after Los Angeles and San Francisco. And tourism is down too, 15% lower according to Time Out magazine, placing Miami just behind Havana, a place with extreme poverty, constant blackouts and riots, as the city with the highest drop in global tourism. This isn't just a cooling market, it's one losing both residents and revenue. One major reason? The cost of living is absurdly high, and the return on that cost is incredibly poor. Services are inefficient, unprofessional, and often come with a sense of entitlement from the provider. As many residents report, everyone is a king, and the one paying is treated like a slave. You're met with poor service, long waits, and inflated costs for basic tasks. Even tipping culture has morphed into satire. 20% tips are now expected everywhere, including gas stations, food courts, and takeout windows. As a friend wisely put it, Miami turned into a battle for money. And when daily life feels like a transactional war zone, the allure of sunshine fades fast, both for residents and investors. So what happens now? Prices are falling, but investors shouldn't expect a quick rebound. Unless condo and single-family home values drop by 30 to 40%, or operating costs come down drastically, which is unlikely, the ROI will remain unattractive. Most sales portals and platforms won't admit this. They survive off transaction volume. But experienced investors know better. It's not a buy when the numbers don't make sense. In the end, blaming the Fed is easy, but the reality is more painful. South Florida's real estate market isn't a victim of interest rates. It's the result of its own unsustainable economics, dysfunctional services, and a declining quality of life. And no central bank can fix that.